Blackberry stock, a prior king of phones that got absolutely wrecked by Apple with the iPhone, is now part of the group of meme stocks, aka stocks that are heavily shorted. Now in this video, I'm talking about how I'm planning to trade around Blackberry and the explosion in implied volatility, and how you can actually put on a bullish position within the stock and have the stock come down in price after this huge run up, and you can still make money. I did the same thing in GameStop back in February, and I'm looking to possibly put on the same trade in Blackberry because I see a very similar setup. And it's important to remember that BlackBerry has pivoted away from smartphones and is more focused now on software and services such as cybersecurity and Internet of Things. The reason I bring this up is because in the bucket of meme stocks, I believe BlackBerry is the least memey, if that's a word. Because the sector that they're in is cybersecurity, so that's a great market to be in. They aren't losing a ton of cash, and in terms of their valuation, it isn't nuts. What they're at right now in terms of valuation and price versus analysts' estimates and targets isn't that far off, right? I don't expect a 90% drop in BlackBerry. So let's talk about the trade itself. The trade itself is selling a put in BlackBerry. So I'm looking at the June 18th expiration, which is 12 days out, and has an implied volatility of 250%. And the strike prices that I'm looking at is around $10.50 or 10 bucks. If we're talking about just right now at the current price, the 1050 strike is selling for around 66 cents or $66. If we pick the 1050 strike, you're talking about risking $1,050 for $66 in profit. But if you annualize that trade for a 12-day basis, that's a 191% annualized return. And I did something very similar in GameStop back in February. I sold a put way out of the money for 84 bucks and bought it back at $5. So the reason it's like that is because the implied volatility is insane, and BlackBerry could possibly come back down to those prices. So why did I pick those strikes? If you look at the price targets on BlackBerry, the average is around $9.50. Or if you use a website like finbox.com, looking at a discounted cash flow model using the revenue for terminal value, you get something closer to around $10.36 as fair value. If you kind of look at a consensus of what the fair value of BlackBerry is across a lot of different websites, you'll get anywhere from about 8 to 10 bucks. So let's call it $9 is the fair value of the stock. Now, because it's trading at 13, you may be asking, why are you selling a put, which is a bullish play on BlackBerry? Now, you have to remember that this is a trade and not a long-term investment. We're talking about a 12-day time span where if the stock isn't below $10.50, you basically collect the whole premium here of 66 cents and it's all profit. This happened back in February, so we have some history of kind of what can happen. There's a huge spike in price, which is going on right now, and then you have a fall in the stock price, but it's not instant. It doesn't go 20 to 8 instantly. It kind of gets walked down over the months as the people that made money from trades kind of walks out of it and the stock goes back to fundamental value. Let's talk about the scenario analysis to understand how we can make money and lose money in this situation. On the making money side, if the stock goes up, we make money because the option would lose value over time and expire worthless. If the stock trades sideways, it would lose value over time and expire worthless. If the stock went down but didn't go past that $10.50 strike price, it would also become worthless. If the stock price is above $10.50 by the expiration date, you would make the full profit. Another way to make money and take the profit before there's actually an expiration date or just taking off the trade earlier is if there's a contraction in implied volatility. So right now the implied volatility is 251%, which is pretty high. If the implied volatility goes down during the trade, then the options become worth less. And once again, you sold it for 66 and you can buy it back at 33 and make 50% on your trade. You also have the benefit of theta decay, which means every single day that passes, you're theoretically making $5.60, so as long as the stock price is above that strike price. You're probably thinking, wow, that's a lot of ways to make money, but let's talk about how you can lose money in this situation as well. Because as I said, with every trade, there's risk reward. So it's not like this is a no-brainer free money. There's no such thing. You have the situation where the stock can crash within those 12 days past the $10.50 strike price. If that happens, you'll be assigned, which means that you'll buy 100 shares at $10.50. So if the stock goes to $9, let's talk about what your losses would be. So if the stock went to $9, you would buy it $10.50, 100 shares, and then you would be owning the stock at $9, so it'd be worth $900. So you'd lose $150, but you have to remember that you collected 66 bucks, so you're down $84, but you still own 100 shares of Blackberry. In that situation, you could start to sell calls against the position and work your way back to a profitable trade or break even. So there's ways to manage it even if you are losing after the 12 days. Here's my game plan when it comes to Blackberry and how I would trade this put. On Monday, I'm kind of waiting to see what happens at the open. If we do get a drop in the price and I can get a put off at 80 cents to $1 at that strike of $10.50, I'll probably go ahead and put on the trade. If it opens up a lot higher and I can't get off a put at that price range that I'm looking at, then I probably wouldn't put on any trade. But I think with the current IV and a slight down move on Monday, Tuesday, and I can get it off at that price, the risk reward looks pretty good. To sum it up, you have a bullish trade that makes money even if the stock comes down. You also have pretty good risk reward when it comes to 190% annualized return, even at that $66 price point on the put. So overall, this is how I would trade these meme stocks or shorted stocks. Sell puts when they're very expensive at a price I don't mind owning the stock at, and you can make some money if the put goes down in price, or you can manage if you get assigned. Hope you guys learned something today. If you did enjoy the video, give it a thumbs up and consider subscribing to Main Street Wolf, where we talk about options, stock investing, anything to do with money. Thanks guys for watching, and have a great day.